What I thought we'd do here quickly, just in terms of format, I want to take just a minute and each introduce themselves. And then I think we'll go into Q&A and then audience questions. Make sure that you guys prepare the toughest ones that you can. With that, so I think we'll start. My name is Zach Streit. I am founder and managing partner at Way Capital. We're a boutique debt and equity capital advisory firm. Started a couple months ago, but came from other larger shops. Our focus is helping entrepreneurial sponsors get their institutional level deals capitalized, and we do a lot in the SFR BTR space.
Hi, my name is David Young, Vice President of Correspondent Lending and Strategic Partnerships with Sharestates. Sharestates is a nationwide direct lender focused on 1 to 4 units, multifam, mixed use, ground-up construction, and some straight commercial as well. Been in the industry almost 9 years now, and this is probably my 4th or 5th IMN, I think. I'm excited to be here. Thanks for the invite.
Sweet. Okay, so there's a lot to cover and get into, and I think we can get into some of the weeds and the nitty-gritty rates, terms, how borrowers position themselves. But I actually wanted to start with a broader question in light of some of the macro stuff that's been going on there. And it's one I sort of thought of that might be the logical place to start here, because people have been asking us and curious to hear what they say. So what are the opportunities right now that you're seeing in terms of debt and equity requests that are coming in front of you for the small and middle market buyer today, whether it's primary versus secondary markets, financing options that you're seeing, et cetera? Because it seems like we're in a more dynamic climate right now than we have been before.
Yeah, sure. We're still seeing good opportunities. Obviously, underwriting heavily oriented on the DSCR calculations and ratio. We're still seeing good opportunities in those loan sizes from, call it about 200K up to 800K-ish in terms of easily hitting the DSCR if the FICO's there, and getting pricing that is still, on a historical basis, pretty attractive, low 6s, mid 6s. Loans below that, I've noticed recently, pricing inching a little bit higher based on the loan size, and then entering into that sweet spot. So if that's the Sun Belt, a lot of the usual areas that you've probably already been focusing on, we're still seeing strong opportunities there at Sharestates and helping our clients get those deals funded.
Yeah. David's point is an interesting one. We finance deals both inside BTR and SFR and outside of them. And it's probably been 5 or 6 years since I've heard lenders say, hey, we're not sizing to a debt yield on the takeout, we're sizing to a debt coverage ratio on our takeout. And that flipped because interest rates moved significantly thanks to the Fed hiking and also us seeing spreads increase out there. So it's almost sort of a back to the future type moment, but I think that's impacted underwriting at least, or is starting to impact underwriting now.
Absolutely. When you could get a 30-year fixed at 4%, punching it into whatever tool you're using to calculate DSCR, a high majority of the loans are hitting without any problem. Now you got to get a lot more granular. You've got rates between, call it 6 and 7. That can change a lot. It might change the leverage that we can lay out on a loan, which can impact down payments or how much cash out you're getting. It's going to impact all of the decisions you're trying to make here as you navigate through your own portfolio building. So basic calculations are probably even more emphasized now in the current environment.
We do a lot of work on the build to rent side, and probably for the last 18 months on that side of the asset class, it's been a struggle on construction costs, as everybody knows, because those have escalated. I would say in the last 2 months, you still have that, although moderating to some degree, but all of a sudden the concept of interest reserve and how much interest reserve you need baked into either a construction loan or a bridge loan has become an issue as you've seen the forward curve for SOFR or some of the other floating rates go up. So this is a new thing that we've had to start negotiating on some deals. How does that get funded? Is it large enough where you need to bring in third-party capital in order to structure that deal and get it done? Is it all funded out of equity? Does the lender just come up in proceeds to help bridge that gap? It's really only something that we've seen over the last month or two. And prior to that, you weren't seeing it because it wasn't of issue. And most of the times when we had construction overages and escalations previously, you would see just lender and borrower ante up pro rata. It's getting a little tougher now. So ensure that you know who your lending partner is, know them well, establish a good relationship, or use advisors like us to help you, I think is kind of important.
Yeah, aren't you finding most all lenders obviously realize what's going on with price escalation? And so generally speaking, I would imagine that you all are taking an active role and at least contributing to those types of things from a debt perspective. I'd be interested to hear how you all are looking at that from a lending perspective. How are you managing the cost overruns? How much are you stepping the loans up, or is it like some sort of pari passu contribution of equity? How are you normally managing those?
You can look at leverage levels to reduce your exposure. Another thing, that's the whole build to rent thing, and long-term rates rising significantly here in first half of 2022, is you're projecting out to the end of that build, whatever, 12, 18 months, depending on the size of the project. And now you need an exit on that, whether it's conventional or through an investor loan, both of which are tied tightly to all the activity on long-term bonds, and we don't really know. So how do we're looking at an ARV, then we're going to anticipate a particular exit. These are things that definitely need to be taken into consideration in this environment. 6 months ago, 9 months ago, it felt like people were assuming we'd have 30-year fixed in this 4 to 5% range for the majority of borrowers into perpetuity. Doesn't appear to be the case now. Additional emphasis on the basics, as we mentioned earlier.
We closed a couple permanent financings in the space, probably back in January or February, and they closed anywhere plus or minus, let's say, 3%. And we were taking some flack of, why isn't this sub 3? But nobody's calling me now to thank me for saying, hey, I couldn't replicate that anymore, so let's go higher. So backing up a minute, what advice do you have for smaller and middle market buyer as they're starting or as they're ramping up to position themselves for programs, and also just to get the best possible terms today?
With first timers or early stage investors, a lot of the things that I see with these folks coming up short perhaps, or preparation wise, is I'd honestly go to the basics. May sound overly redundant, but FICO, track record, and liquidity. Is your credit score as high as it possibly can, particularly for term? Track record, we need to see that, even if it's a term loan, particularly with a first timer, we're going to need to validate that they do own and reside in their own primary, or reside in their own primary rental. Confirm that. And then the liquidity, people are coming in, they don't necessarily have all the proper documentation. It needs to be tidied up. Where did it come from? Where's the paper trail? Basic things like that. Honestly, we see people either walk away or get dissuaded or not ultimately come up with all the basic documentation that's needed. Once we have that, we can get into a lot of the granular detail, work folks at Sharestates and help you get to the finish line. But if you don't have the basics lined up initially, then it's going to, at a minimum, delay the process, if not possibly derail it.
So what are some of the, just as a follow-up question to that, some of the unique features in loans, just to educate sponsors out there who are coming to you, that they probably need to be ready for, because they're going to be lender expectations if you want to clip in best possible financing rates out there?
Being organized allows you to be more flexible. I've seen a lot, particularly this year with the rate vol that we've seen, oscillations between perm and bridge, depending on the project. Or maybe it's a short-term rental somebody's trying to acquire, and bridge might be the best way to go on that, or it doesn't hit the DSCR because of rates moving sharply in a short period of time. Whatever that case may be, to have everything organized, particularly for early folks, newbies, is going to give you much more flexibility to adjust on the fly if you have to. For a single family, it doesn't necessarily come up as much, but if you get into mixed use, multi, or other types of assets, definitely going to need to have everything aligned properly so you can adjust if needed.
Let me ask a bit of a contrarian question here, and it plays off some of the themes that we've talked about. Clearly, higher interest rate, higher cost of debt, that makes it a little bit tougher. It means that you need a better return on cost on the deals that you're doing. But what about from a macro perspective? Is it possible, in your mind, first, if higher rates make it tougher for homeowners to afford a mortgage and therefore push them more to become renters than buyers? And then a second sort of add-on question to that would be, what is the contrarian play out there today? Is it taking a floating rate loan in the face of higher rates in your mind? Curious of what are some of the opportunities in this environment?
The first aspect of that, clearly, as mortgage rates rise in the conventional side, or long-term rates in general, there are going to be, I think more so on prospective buyers, that may maintain their renter status, which is going to increase the overall pool of renters theoretically, is certainly something to consider. But I'm seeing, or at least with the lack of inventory or lack of listings, particularly in, I know my area is a microcosm in Boston, but people just hunkering down. Like if they don't have to sell or have to move and rates are higher, if they feel like what they're going to get is not what they would want, or what they're able to buy after moving is not what they want, there's a certain element of hunkering down, which could reduce listings even more, forcing more people again into the renter pool.
What about the wall of liquidity in your mind? That's the other big offset to higher interest rates I've been hearing, is that there's just so much capital out there due to Fed printing, due to equity capital sources, be they institutional capital sources or high net worth capital sources. What impact do you see as those having on the market? Is that another offset or a contrarian play, but something that could offset higher rates?
I think it's a buffer. And you got to look right now, the Fed keeps jawboning higher rates and tightening and this and that, so-called quantitative tightening, but the balance sheet has not shrunk yet. So they haven't actually tightened by pulling liquidity from the system. They pledged to do that in the very near future, but it hasn't actually happened yet. So that remains to be seen how aggressive they actually get with that. Certainly still been a lot of asset appreciation since roughly 2010 in this country and globally. And there's a lot of money sloshing around. So I think it's a buffer, but it's also an opportunity for folks that are asset heavy to kind of hold on and wait. So there's a double-edged sword there.
All right, I'm going to ask my crystal ball question here, and I want to open it up to the audience. Your view on where perm rates and bridge rates are at year end today?
My view, not necessarily Sharestates, I want to be very clear about that. My view is another surge upwards is certainly plausible, but I ultimately see a reversal that I think could certainly begin before the end of the year, not necessarily pick up a lot of steam by the end of the year. I think it could pick up significant steam in 2023 with a reversal to more easing.
I'm hoping for what David said, but I'm not sure. I want to take one question that came up from the panel over here. Do you think institutional SFR will have any spillover effects on other asset classes like multifamily or create new asset classes? But I'm not sure if that means, is there a saturation in it? So dollars that would have gone there have gone elsewhere, but feel free to take a crack at it.
I mean, speaking from the demand side, from the borrowers and sponsors, just seeing more and more interest in multifam and ground up, clearly. So logically, I suppose there'd be more of an institutionalization of those asset classes.
Yeah, I would think so too. I'm not sure I see a spillover effect into other asset classes. I think the spillover has been into this asset class. We were meeting with an equity capital source this morning, actually two, that had historically done a lot of multifamily, both ground up and also acquiring existing. And they're here at this conference because they want to find a way into single family for rent or build to rent. So I don't think I see that stopping because of capital flows, demographic reasons, et cetera, et cetera. And with that, thank you. Panel was awesome. You were great. You made my job easy. Thank you, everybody.